Hey guys, how's it going? I'm Lewis Harding Investor and welcome back to the channel. And in today's video, I'm going to be going through 3 UK stocks to buy now in 2022. Let's get straight into it. So a company one on my list is British American Tobacco. So BAT is a British multinational company that manufactures and sells cigarettes, tobacco and other nicotine products. The company itself was established in 1902 and is headquartered in London, England. As of 2019, it was the largest tobacco company in the world based on net sales. BAT has operations in around 180 countries and it's got all sorts of brands including Dunhill, Ken, Lucky Strike, Pall Mall and Rothmans. It's also got like the vape brands such as Vipe and Views and Glow. BAT is a primary listed on the London Stock Exchange and it's a constituent of the FTSE 100 index. Now let's have a look at my analysis checklist for BAT, and yeah, let's start with the first pillar I've got: profitable, high returns on capital, low leverage. So this company is very profitable itself, high gross margins, 80% 5-year average, net margins 5-year average of 21%, so very profitable company, which is awesome stuff. We love to see that. Return on equity is also very high, way above the 15% 5-year average like to see, at 30%, which is awesome, really good. Long-term debt to equity, currently that's 39%, so not too bad in the grand scheme of things in terms of the size of the company. Current ratio is below 1 though, which is not good. I like enough current assets to pay all current liabilities at least, but it might be to do with the manufacturing sector it's in, but it's still a bad sign nevertheless. Proven ability to grow. Over the past 5 years, the company has grown across all the 4 different metrics. Disclaimer, they did have a big acquisition in 2017, I believe, which has caused the revenue to go up massively. They used debt and shares to do that, so yeah, that is why the growth pillar is showing a lot higher, and that's $67 billion worth of shareholder equity growth. Yeah, it's just a bit skewed because of that, but yeah, just needed to let you know that. Great capital allocation, so in terms of that, long-term debt issued for 29 billion of debt, which is linked to the acquisition. Yeah, you want that to be going down over time, because yeah, you don't want increasing debt all the time, but the board do have a plan, management do have a plan to pay down the debt over time, and using the free cash flow to do that. Dividend growth, yeah, tobacco companies are known for a big dividend, so yeah, this is probably going to continue to grow over time, which is really good. Decreasing shares, this is in the red, but this relates to acquisition once again, so you can see it's all interlinked a little bit. Good acquisitions, I would say it is a good acquisition because they've gained some cigarette brands, increased the sales and profit, and we can have some cost saving efficiencies as well, so it can make the profitability of the business better over time. Quality score of 77%, so not too bad. It needs updating for 2021 figures. I'm just waiting for macro trends to update, but yeah, it's still looking fairly solid nevertheless. Buy at a fair price, currently P ratio of 11 and price free cash flow of 8, which is really low and cheap in my opinion. DCF valuation 10% return, looking at a £50 per share price, and current share price is hovering around the £30 per share mark, so quite a lot of uplift in terms of this one in my view. A quick look at the DCF valuation for BAT, free cash flow estimates from marketscreener.com, required rate of return of 10%, share price of £50 per share, so yeah, it's currently looking undervalued based on these figures. Free cash flow stagnant / growing minutely over time. Yeah, this is, yeah, what can I say? It's looking pretty decent. £50 per share for a 10% return, looking at £30 per share for a 15% return. So if you did want that bigger margin of safety, it's looking like a decent deal in my view based on the numbers. So company 2 on my list is Rio Tinto. So Rio Tinto Group is an Anglo-Australian multinational and the world's second largest metals and mining corporation, behind BHP Group. The company produces iron ore, coppers, diamonds, gold and uranium. The company was founded back in 1873 and it's named after like a mine in Spain or something. Fun fact for you. The company itself is dual listed, so it's listed in London and Australia. So yeah, it's part of the FTSE 100 index, it's part of the Australian index as well. Yeah, the company itself has been criticised for environmental concerns by the Norwegian government, and they actually divested from Rio Tinto through their sovereign wealth fund. Now let's have a look at my analysis checklist for Rio Tinto, and Yeah, we'll start with the first pillar, profitable, high returns on capital using low leverage. So profitability wise, 77% gross margins, 5-year average, very solid. Net margins, 22%, 5-year average, way above what I like to see. Return on equity, 5-year average is 18%, which is really good. No complaints there. Then looking at the debt situation, long-term debt to equity, it's 21%, current ratio 1.8. So there's a lot of liquidity in the business, not much debt. Yeah, all of them things is what I like to see in the business. Proven ability to grow, yeah, across the board green once again, which is really good. You do have to realise that 2020 and 21 have been really good years for Rio Tinto, so you can't expect that to go on forever. But yeah, this is what the 5-year pillar is. It is what it is. You just have to take it with a pinch of salt and look at it on a maybe even a 20-year time scale. Look what we've done over the past 20 years. But over the past 5 years have done well. But yeah, just be warned that it probably won't be as good as that for the next 5. Great capital allocation, long-term debt repayment. They have repaid debt, grown the dividend, decreased shares, and had some good acquisitions. So the capital allocation is looking very solid for Rio Tinto. Quality score of 100% for at the minute, which is really, really good, of course. Can't get any better than that. Buy at a fair price. The most important part, buy at a fair price for a good valuation. P ratio of 5, price free cash flow of 6. Yeah, it's looking cheap based on that. DCF valuation for a 10% return. We're looking at a share price of £51 per share, so it needs to drop by a little bit as at time of recording. And yeah, the reason the P ratio and price to free cash flow ratio is so low is because analysts expect in the coming years that the earnings will decrease, and hence the P ratio will return to a more normal figure. So it's not as cheap as it seems to be on the face of it, but it's looking reasonably priced at the minute. Now let's have a look at my DCF valuation for Rio Tinto and free cash flow estimates from marketscreener.com, all in US dollars because that's how they report. Rate of return of 10%. We're looking at a share price of £49 per share and £51 per share if you just for the net cash of the business. Free cash flow, as you can see, 21 and 22 is looking higher than normal. It will return to a more normal figure, and that's why it's showing the share price has to come down a little bit. But that's not necessarily a bad thing. It is expected that the free cash flow will return to normal levels. If you can buy below, say, £50 per share, you've probably got a very solid investment there. A solid company, I must say. It might not be a good investment if the free cash flows do not live up to expectations, but based on them figures on that screen, it's looking like a fair price if you can get below £50 per share. The third and final company on my list is Games Workshop. So Games Workshop Group plc is a British manufacturer of miniature war games. The company is based in Nottingham and its best known products are Warhammer Age of Sigmar and Warhammer 40,000. The company was founded in 1975 and the company was originally a manufacturer of wooden boards for games including backgammon, Mancala, Nine Men's Morris, Go, and it became an importer of US role-playing game Dungeons and Dragons. So yeah, the company does sell worldwide, and it started promoting games associated with Lord of the Rings in 2001. It also owns Forge World, which makes like resin miniatures and conversion kits, and the company itself is listed on the London Stock Exchange. It's a constituent of the FTSE 250 index. Now let's have a look at my analysis checklist for Games Workshop and profitable, high returns on capital using low leverage for my first pillar. Gross margins and net margins are very high for this business. 70% gross margins 5-year average and 27% net margins 5-year average. Really, really good stuff. Return on equity is at 67% 5-year average, way above the 15% I like to see. Yeah, very, very high quality business here. Long-term debt to equity is only 24%, so not a lot of debt at all. Current ratio is 3, so a lot of liquidity, you don't have to worry about them going bust, let's just say that. Proven ability to grow, yeah, we've had fantastic growth over the past 5 years or so. Very, very impressive in fact. High rates of growth with a lot of profit and cash flow as well, which is very rare but awesome. Great capital allocation. Yeah, long-term debt repayment. We haven't repaid any debt. I know we've issued a little bit of debt, so that should be in the red. Like about 40 million worth of debt. So it should technically be a red. I will update that going forward. Dividend growth. We've been increasing the dividend as the business has been growing. Decreasing share count, been buying back a few shares, and some solid acquisitions along the way. So it's showing a quality score of 100% or near enough that with the long-term debt figure should be red. But yeah, the most important bit, buy at a fair price, buy at a fair valuation. So currently PE ratio and price to free cash flow 19 and 22 respectively. So it's looking interesting. DCF valuation for a 10% return, I'm getting a share price of £69 per share. Current share price is hovering around the £70 per share mark. Now let's have a look at my DCF valuation for Games Workshop, and yeah, free cash flow estimates from marketscreener.com once again. Rate of return of 10%. We're getting a share price of £67 per share, but then if you adjust for the net cash for the business, it's £69 per share. So yeah, currently it's looking around the ballpark. It's looking like a fair price for Games Workshop. I like this one personally. I do own it. Well, I own all three to be fair, but this is probably the highest quality UK business I've ever seen. If you've found any others, please show me, because I haven't seen them personally online or on some screeners. But yeah, this is a very high quality company. It's currently trading for a fair price in my view. I'm happy holding at these prices, and I think over the long term it'll reward us as shareholders. But yeah, really good stuff. Now let's have a look at the genuine impact ranking system for all three of these businesses compared to each other, and we'll start with the quality metric. So currently Games Workshop is the highest quality out of all three, which is no real surprise to me. Very high quality business, 281 in the ranking system, really good. Rio Tinto comes in second, and then British American Tobacco third, which is a long way off the other two. So it's like Rio Tinto and Games Workshop are very high quality businesses. But then we'll have a look at the valuation side of things in the value pillar, and yeah, British American Tobacco is the cheapest out of all of them, ranking from top to bottom, BAT, Rio Tinto and Games Workshop. I don't quite believe Games Workshop is that overpriced in my opinion, but yeah, the ranking system has clearly found something in there. It's not liked. Momentum wise, I don't cover this, so I won't really mention it. Momentum's more related to trading, doesn't really relate to value investing at all. But yeah, some interesting stats there from Genuine Impact. So there we have it. They were 3 UK stocks to buy now in 2022. If you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.